Once hailed as America's ultimate budget-friendly retailer, Big Lots thrived on offering extreme discounts and an exciting treasure hunt experience for shoppers. But in just 3 short years, this retail icon tumbled into bankruptcy. What went so wrong, and is there still hope for Big Lots to reclaim its throne? Let's dive deep into this fascinating story, right here on Invest Vision Hub. Big Lots wasn't always the household name we know today. It began in 1967 as a small operation in Columbus, Ohio, under the name Consolidated Stores. Its founder, Saul Schenck, built a business on a simple but clever concept: buying excess inventory from wholesalers at rock-bottom prices and passing the savings on to customers. This strategy earned Big Lots a loyal following, as shoppers reveled in finding unexpected treasures for unbeatable prices. The business grew quickly, opening new locations across the country and eventually adopting the name Big Lots. By the early 2000s, it had cemented itself as one of the largest closeout retailers in the United States. Customers loved the treasure hunt experience, where they could discover everything from home goods to holiday decorations at steep discounts. But as Big Lots scaled up, cracks began to appear in its business model. The more stores it opened, the harder it became to rely solely on odd-lot inventory. With limited surplus goods available in the market, Big Lots shifted to pre-planned purchases, moving closer to a traditional retail model. This change brought challenges. Competing against giants like Walmart and Amazon meant Big Lots often struggled to offer competitive prices on everyday items like groceries and household essentials.
The pandemic boom and strategic missteps. Ironically, the COVID-19 pandemic brought a temporary windfall for Big Lots. As lockdowns kept people at home, demand for furniture and home decor skyrocketed. Consumers, armed with stimulus checks and boosted unemployment benefits, splurged on making their homes more comfortable. Big Lots, with its focus on furniture and home goods, was perfectly positioned to capitalize on this trend. By 2021, the company's revenue hit record highs, and its stock price peaked at $70 per share, valuing the company at nearly $2.5 billion. It seemed like Big Lots had cracked the code for long-term success, but behind the scenes, the seeds of its downfall were already being sown. The company made several strategic missteps during this period of success. It invested heavily in 2 massive distribution centers to meet surging demand for furniture. These warehouses became costly liabilities once demand plummeted in 2022. Additionally, the company authorized over $400 million in stock buybacks, an aggressive move that drained much of its pandemic-era profits. And to make matters worse, these buybacks occurred when the stock was trading at its all-time high, offering little long-term value. The post-pandemic decline. As the economy began to normalize in 2022, Big Lots faced a sharp decline in sales. Furniture, which had been its top-performing category, saw a 23% drop in revenue. The novelty of home improvement faded, and consumers turned their attention elsewhere. Meanwhile, rising labor costs and inflation ate into the company's already thin profit margins. Another major issue was Big Lots' shifting identity. The company's hybrid model, part discount retailer, part traditional store, left many customers confused. While its odd-lot bargains remained popular, its prices on everyday essentials often couldn't compete with Walmart or other large grocery chains. Even in furniture, Big Lots faced stiff competition from specialized retailers and online platforms. Adding to the pressure was the rise of e-commerce. Websites like Temu and Wish began offering a similar treasure hunt shopping experience, but with the convenience of online browsing and even lower prices. Big Lots, slow to adapt to the digital age, struggled to retain its customer base. Bankruptcy and uncertain future. By 2023, Big Lots was losing money at an alarming rate. Its operating expenses ballooned to $2.1 billion, 20% higher than pre-pandemic levels, while revenue fell 14%. With mounting losses and dwindling cash reserves, the company filed for Chapter 11 bankruptcy protection in September 2024. As part of its restructuring plan, Big Lots announced the closure of 344 stores, leaving around 1,000 locations still operational. These closures, while painful, were necessary to free up cash and reduce operating costs. However, bankruptcy severely limited the company's ability to secure financing, leaving its future in jeopardy. There is a glimmer of hope. Private equity firm Nexus Capital Management has agreed to acquire Big Lots for $750 million. The funds will be used to pay off some of the company's debt, but it's unclear whether Nexus can successfully turn things around. Their plan reportedly involves returning Big Lots to its roots as an extreme value retailer, focusing once again on odd lot merchandise. The big question. But even if Nexus succeeds, the bigger question remains. Can a brick-and-mortar retailer like Big Lots survive in an era dominated by e-commerce? Competing against online platforms that offer both convenience and low prices will be a monumental challenge.
Big Lots' story is a cautionary tale about the challenges of adapting in a fast-changing world. But what do you think? Can this iconic brand make a comeback, or is it destined to fade away? Share your thoughts in the comments below, and don't forget to like this video and subscribe to Invest Vision Hub for more insightful content on the world of business and finance. Thanks for watching, and we'll see you next time.